I may not be able to get the losses against my W-2, but I'm making returns and I'm not being taxed on those returns because I have these losses to offset it. So I don't want to be all doom and gloom in the
Right.
situation, but it's like there's a positive light to it where like you're still increasing your net worth, you're still bringing in income that's not being taxed. You're just being taxed on the income your main business or your W-2. That's the part you have to deal with.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Larry Pendleton is a real estate investor and CPA with a passion for adding value to fellow investors through tax consulting and accounting services. He says his mission is to help people achieve financial freedom through real estate investing and tax strategies. Larry, welcome to the show.
Thanks for having me.
Hey, man, pleasure's mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Started in Norfolk, Virginia. I guess from a CPA perspective, I really started in my accounting in high school from my high school crush on an accounting teacher. Ended up turning that into a CPA certification and accounting degree there. So been doing that for over a decade now. Didn't work out with the teacher, so that's no reason to go down that path. But started off in real estate roughly 7 years ago. My partner Terry on Connors was already investing. I didn't think I could do it. Just limited mindset. He basically put a property in my lap, get an FHA loan. Still have it today. Cash flowing 300 a month, and like I said, been able to take that and expand that to grow my portfolio and grow the tax business to be more real estate focused.
Gotcha. That's really, really interesting. Yeah, I think I guess you as the student can have the crush on the teacher. It's the other way around that you get in trouble with the law. I think, right?
Yeah, exactly.
Oh, that's hysterical, man. Thanks for that. That's a good laugh and a great place to kick this off. I guess when it comes to the accounting side of things, what are you seeing right now in the marketplace? You know, as you're talking to different investors and you're talking to different people, like what are some things going on right now in the accounting world that we should be aware of?
One I think most people are aware of is that the 100% bonus appreciation that a lot of people have been taking advantage of over the past 5 years, it starts to phase down in 2023. It goes down to 80%, 60%, so forth and so forth, waiting on to see if the IRS is going to make any changes or just amendments before it completely phases out, or we'll be back at 50% like we were before 2017. We're also seeing the IRS pump a lot of money. I mean, the government pump a lot of money into the IRS, which technically means there's more audits coming as they're trying to recoup a lot of the money that they've been paying out over the past couple of years. So for those investors, especially those that's been trying to qualify real estate professional status or have been qualifying real estate professional status, making sure you're tracking your hours. And I'm also seeing from working with a lot of syndications and funds, for those that are limited partners, just being sure that whatever losses or the tax losses that your operator or syndicator is promising or offering, like, can you really take advantage of that in the current year? In a lot of situations, we're seeing a lot of people not being able to take advantage of them and wasn't aware of that until they get their K-1s and file their taxes. And it's like, well, no one told me I couldn't claim these losses this year. I thought I could have. So it's like just getting informed up front from your operator or from your tax advisor or from a tax advisor that knows real estate and how that may affect your taxes.
Let's talk about that for a second. What are the situations in which a passive investor cannot take advantage of a loss on a K-1?
So if your income is over $150,000, then you're limited to the passive loss limitations under Section 469 of the IRS tax code. So that means, I mean, unless you can qualify for as a real estate professional, which means it's the 750 qualifying hours and more your half your work time in real estate. But if you're a doctor or or a business owner that's not in real estate, it's kind of hard to prove that you have the qualifications to claim real estate professional status and then show that you materially participated with those properties as a limited partner, you're not really making any management decisions. So that's where you kind of get hamstringed in certain areas. And there's strategies around it. If you're doing short-term rentals and you have your own properties, you can somewhat group all your activities together. But if you're just kind of just one syndication here, or just you're only doing LP investments, you may be limited to how much losses you can claim.
Can you break that down? I guess give me a hypothetical example. Let's say you're a doctor and you make $500,000 a year. How much? And you get a K1, and you say you invested $100,000 in a deal, and you get an $80,000 write off the first year. Again, we're just making stuff up here.
Right.
What percentage of that could they actually take as a write off, if any?
So in that scenario, in year one of that syndication, the answer is none. If all they have is, if they have their W-2
Yep.
and over that $150,000, and then they invest in this deal and they got this $80,000 loss. Now it's important to bring up that even though you can't use it in year one, that doesn't mean it disappears.
Right.
It is suspended and rolled forward into future years, which means that it's going to offset future gains or passive income and passive gains from any passive activities or other rental properties or syndications that individual may be involved in. And also, when that property goes full cycle, any losses that's been built up along the way then become active, and that will help offset the capital gains on the back end. So if your goal is to really get into these losses offsetting your W-2, and you're a high net worth individual, you may be a bit out of luck from that standpoint.
Right, and that's something I think, and thank you for taking the time to clarify that there, because I think that's something that is often touted in commercial real estate, especially in syndications, is, hey, there's tax advantages here. But yet I think there's a lot of ambiguity, especially as it comes down to, the example we just set forth of like, hey, what can someone actually take as a write-off? And it sounded like you said that somebody could group that too. So if they had short-term rentals that did make a bunch of money, maybe then they could go ahead and claim the full amount there. However it works, I know everybody's situation is unique, but
Yeah. It's also important to bring up where it's like it's a mindset where like you can take the offense into this, where okay, I may not be able to get the losses against my W-2, but I'm making returns and I'm not being taxed on those returns because I have these losses to offset it. So I don't want to be all doom and gloom in the situation, but it's like there's a positive light to it where like you're still increasing your net worth, you're still bringing in income that's not being taxed. You're just being taxed on the income that whether it's your main business or your W-2, that's the part you have to deal with other strategies to offset that. But there's still a bright side of investing in real estate as an LP and being able to make more money. That's not going to be has less tax liabilities as W-2 income.
right. Yeah, absolutely. Absolutely. What's it like being a CPA and also an investor in real estate? I mean, do you feel like that brings you or gives you any unique advantage in your CPA side of the business?
Yes, because it helps me be able to bring more value to the seller. Where it is, if I can understand their pain points, where there's a deal in Cummings, Georgia, where the person didn't know what their capital gain hit was going to be,
Hmm.
and they either didn't have an advisor or their advisor didn't know. But so part of my role on that particular team was to go through and like, hey, here's your option. I gave them three options. If you sell at the price that we're asking. If you sell or finance it to us, here's your tax implications, and if you just do a lease option with us, here's your tax implications. And the fact that he ended up selling at the full value because he realized, okay, if that's my taxable gain, he just wanted to get out of real estate, which is fine. We really wanted the the lease option or selling
Sure.
something we could have to bring in less money to the table, but it worked out. We still got the price, and like he received a lot of offers, but he wasn't the highest offer either. So something like that was like, okay, I have a unique perspective to bring additional value to at least to the sellers and to even to the buyers for the teams, if I'm on the GP myself or just consulting from that standpoint. Because I'm not, as I tell my clients, I'm not on one side of the table and you're on the other side. Like we're both on the same side of the table because if the deal looks good, like I may want to jump in myself.
Right. That's an interesting strategy I hadn't thought about. Was especially, I mean, we're in an asset class right now in the RV resort space that is almost exclusively mom and pop.
Hmm.
And it's one of those things where, that opportunity for seller financing, oftentimes exists because they don't know what they're going to do with the money. But I think, that you give them $5 million and they're going to go, okay, now where do we put it? But
Yeah.
it also unique spot to be in that, you could almost offer a consulting call with an outside person such as yourself and say, hey, look, let me pay Larry $1,000 to have a phone call with you, and then this will help you kind of lay down somebody. I don't know, I'm making up numbers here. You might be 10,000. I don't know, but whatever it is, have a phone call with a qualified CPA if you don't have one, because this may help you decide what your next route is, based on what the tax ramifications are. So I hadn't really thought about that before, especially as we're dealing with, and I don't want to use this word, but less sophisticated sellers, maybe. Than what you would in some other asset classes.
Yeah, especially, I mean, a lot of people, especially in the multifamily space, where there's a lot of emphasis on the 10 to 80 units, because that's typically just does not your hedge funds, like those similar as like it's your mom and pops, and they've been running this thing on their own for 20, 30 years, and they're just tired and they want to get out.
Right.
But there's a fear of like, what's the other side of receiving a huge lump sum um off of this nest egg that you built over the years is what you built, but there's the IRS is kind of waiting on the other side to see what you
Right.
do next.
The tax man cometh. That's for sure. That is for sure. Tell me on the acquisition side, how are you finding opportunity right now?
A lot of, as I mentioned, like I've worked with a lot of different investment groups, and so what I've seen is always a lot of mailers, especially with the hot market. It's tough to go through brokers on any asset class. So there's a lot of just mailers trying to get to direct the owners as much as possible. As cliche as it sounds, driving for dollars is still a thing, and it's still, and so you just happen to drive past something and it was like, hope put in reverse and to get this address written down, whether it's a house or it's a vacant lot or empty building. So yeah, there's a lot of different ways and how people are sourcing these deals. And I have unique perspective of being able to see the multiple ways of people doing it.
Man, that's awesome. When you look back on either your CPA career or your investing career, has there been bad advice that you received along the way, and or good advice that you feel like people should hear?
Bad advice, almost the aspect of, it's weird because I tell people I'm rather in a unique position where I've been like CPA masters, and it's like I feel like I've been climbing this corporate ladder. It's like this is up against the wrong building.
Hmm.
So if I had the opportunity to start this whole like start back at 18 all over again, like I probably just would have just jumped straight into real estate. And it may not be a CPA as of now. I'm not saying that it's bad advice. It's just I'm conflicted by it because it's been a huge part of my success. But and now I'm starting to at least embrace the grind throughout the years of doing it to get to this point. But the best advice overall, even from a tax, from a business investing standpoint, is like it's the cliche of work smarter, not harder, like hits harder once you realize that you tax more on on non-passive activity like having a job or just running a business. So it's like, okay, the quicker you can get into being a passive investor, the better. Like, because I'm more and more, especially with two young boys, like I'm just really like concerned about like how much time I'm really getting to them as many other people are building our empires, in two separate fields.
Right. Yeah, that's absolutely right. And that's funny, man. People ask me that question all the time. They're like, hey, where do you want to be in 10 years? I'm like, well, in 10 years, I'll be 50. And in 10 years, I want to be a passive investor only. I hate to say that, but it's like, that's where I want to go. Like, I want to do all the things that I'm doing now for my passive investors in my deals. Like, and I want to invest passively, but I'm not strictly passive investments. I've still got to generate revenue in order to put more money into passive investments. So
Yeah.
it's one before the other. But
Yeah.
I hear
Part
you.
of it also is and it's not so much as bad advice as it's what you notice people just kind of trying to do all this on their own.
Mm.
And they may not have said that, but like if you're operating as such, like, and people are observing you, like you're giving bad advice where, uh, like this is a team sport. Like life in general is a team sport. Like you're not going to be able to do any of this and scale and be able to do uh what you want in life if you're just trying to put your head down and grind through everything on your own. So like to be able to be of value to someone, to partner with someone or a group of people to do something bigger, that's kind of how I see where, like, for me, speak for myself at least, like that's just a brighter future from that standpoint.
Right. Yeah, that's absolutely right. And I guess that brings me to one of my last questions, which is, you said that you've partnered with a lot of different people and a lot of different teams. And it sounds like a diverse geography as well. And that's kind of how you've scaled your personal portfolio. Is that right?
Yeah. So jumped around from single family rentals to short term rentals, done some flips, burned and crashed on some flips. um, and like I said, now it's just okay how to scale it, and there's like okay get into the larger multifamily commercial properties, where like I said, if I can get 1% of 1,000 deals, like I'll do my 1% at the best of my capabilities, and I'll move on from there because I know that's not going to take too much of my time.
Right, right. Man, I love it. I love it. You've given us some great things to think about here, Larry. Talking about the bonus depreciation and how that's fading out. Thinking about more audits coming down the pipe. That's never something that any of us want to hear. But like you said, I know they've pumped a ton of money into that side of the IRS. So be looking for that. The tax losses thing I think was really really interesting, just in the sense that we oftentimes hear about all the ways you can use passive losses and things like that. But I think the key there in this whole conversation was reach out to your CPA before you count your chickens before they're hatched, because that you may or may not be able to take advantage of that if you are a strictly passive investor. And then you've just given us some other cool things that, key advice and key mistakes you've made along the way, and things that you'd say, hey, this is the way you do it differently, and also the way that you would do it, for the good advice you receive. So, yeah, I love it. I appreciate it. Thank you for coming on today and sharing so much with us. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yes, I appreciate Sam. So I'm available on all social networks. It's typically Larry Pendleton CPA. I'm pretty sure my link at will be in the show descriptions. That's basically my digital business card. Right there. My phone number 757-535-8592. Like shoot a text. Like I try to respond within 48, 72 hours of texts and voicemails and emails as well. But Facebook, Instagram, LinkedIn. Haven't tackled Twitter. Get a little behind the times regarding that. So, but I'm three out of the four. Well, I
I
guess
hear
three
you,
out of back.
man.
I'm not on TikTok either.
I hear you. I hear you. Yeah, those are platforms that I think for some of us have been harder to find the time to invest into, but certainly appreciate it, Larry. Thank you for coming on the show today. And yes, of course, we will link all of that there in the show notes. So thank you again. I do appreciate it.
Appreciate it, Sam.